consider this a professional courtesy.
Hello, everyone, and welcome to another edition of Real Estate Realities with the Rebel Broker. My name's Robert Whitelaw, and I am the Rebel Broker. Licensed real estate broker in the state of California, member of the National Association of Realtors. But please, don't hold that against me. Welcome to it, folks. We've got some interesting news for you, a few little tidbits to share with you today. As always, the very best way to get in contact with me is through the website. You can do that over at therebelbroker.com. From there, you can send along any ideas, suggestions, whatever might be bouncing around in your head my way. You can click on Contact in the menu bar and go to the usual places, fill out the usual stuff, and send me whatever it is you'd like to send me. Of course, from there, you can also join the Rebel Underground. There's several buttons across the site. The player has it embedded in it, so there's plenty of places for you to find an opportunity there to join the Rebel Underground, which is a group of folks who listen to the show who want to get more information. I promise you don't get spammed. I don't sell your information to anyone else. And even I don't use the list enough. I have folks who signed up again. Hey, I want to get some of that inside love, and it's going to happen. I promise. It's just one of those things that's sort of been put on a back burner for a while. And another way to join is to text the word Rebel Broker, the number 44222. That's text the word Rebel Broker to the number 44222 if you're not in the mood to go out and do the WWW thing. And finally, if you'd like to put your name in the hat to win that $50 Amazon gift card that we've been doing on a monthly basis, click on the big red button at the top of the page titled Take the Survey to Support the Show. You'll do exactly that. You'll be asked some demographic style questions, but you'll also be asked for your email address. Just use the same email address both times you're asked. Make sure it's an email address that you check, probably daily would be good, because when we do the drawing for that $50 Amazon gift card, that's how we're going to reach out to you. And then ultimately, once I verify there's a human being on the other end of that email, that's how you get the $50 Amazon gift card. So good luck to those of you who have yet to win, and there are those who have yet to register, and congrats to the folks who have won so far over the past. Have we been doing it a year now? I almost think we have. But lots of folks. We've had lots of winners for over the last at least 8 months. I think we've given away $800, $700 something dollars. I'm not even sure. All right. Let's go ahead and jump in. A couple of interesting tidbits today. I always like to talk about housing starts because that's one of those things that gives us an idea of where things are going to go. And up until now, housing starts have very, very much been dominated by multifamily style dwellings, which is, I guess it's good. Any increases to living options is good. But so much of that has been apartments. So that's really what has been dominant. I know in my marketplace, that's absolutely true. And what's really odd is I look at some of these developments and realize, at some point in the not too distant future, these are going to be the least desirable places to live. I mean, they're the ones I see when I drive up the 85 freeway, for instance. There's like 9 buildings. Each of them have like 9 or 10 floors. People are packed elbow to elbow. If anything is going to turn into the least desirable housing in the valley, that's the kind of stuff that's going to do it. And I get that the demand at this point really sort of feeds this beast. But man, it's going to turn into a situation where that particular housing is going to be the least desirable from the standpoint of where folks want to live. Now, eventually, maybe those go condo and people start buying. But again, among condos, that would be the least desirable scenario. So what I'm looking for is a switch. I'm looking for more single family residential style, or maybe even not that. Maybe even if we just went with row houses, but at least not multifamily, not apartment buildings is really what's going to satisfy the demands of so many of the folks who are out there as buyers. Now, we've got a couple of articles here. Quarterly housing starts by intent for the fourth quarter of 2017. We can compare that to previous years. I'm going to include a link to calculated risk, which is where I'm getting one of these two articles from. And I think it's a useful one, particularly when you look at single family built for sale numbers. And we're still nowhere near the peak of 2005. We're actually nowhere near even where halfway through the run up to 2005. We're more in line with what that number was back in, let's see, if we go back to say 1995, I guess, right in that ballpark, we had those numbers showing up in terms of single family built for sale homes, and it's just really not satisfying the demand. I mean, clearly there's a big demand out there for it, but we just haven't gotten anywhere close to being where we were at the peak, which is probably 2 or 3 times greater than where we are currently. And that's what concerns me about the market. I mean, when we talk about this, we've talked about a lot of different elements that I consider to be fundamental to it, to the market we're in. Unemployment is one thing I've always talked about. Having folks, in order to qualify for a loan, you need to have a good job, right? You need to have a job where you can earn the amount of money where you're able to borrow money to purchase a home. So that's always a cornerstone, right? Without that, things don't tend to do well. But one other thing out there is you need to have a reasonable supply. And right now we are riding a real estate wave that is built entirely on a lack of supply. It's just there isn't enough out there of any kind, right? We talk about how the stuff that is getting built tends to even be the stuff that doesn't cater to the largest number of people. Well, it can't anyway, because we're simply not building enough. If we just talk about number of units being built, we're just not there. So whether you're talking about luxury homes or not, we're simply not building what needs to be built to satisfy even a fundamental level of demand. And that's one reason why I'm not hugely convinced by what everyone talks about being this amazing real estate market, because we're not producing the product at a rate that comes anywhere near what we've done, even in times past when the market was considered relatively not hot. If you go back and you look at years when it was not a particularly high growth market, prices not going particularly crazy, we're not even really producing homes at the same rate that we were doing then. When you fold into that some of the economic uncertainty that has fed folks into staying in their homes longer, the net result is just tons fewer homes out there in inventory. Now, let's go ahead and explore this a little bit more. We'll start with the IRS Media article titled "Housing Starts Blow by Expectations." Well, expectations weren't that great anyway. Quote, home building activity blew by expectations in January. Now, remember, the other numbers we were talking about were for the fourth quarter of 2017. Now, these are numbers for January. Month-to-month numbers are a little bit more difficult to pin. I find that usually if we want to talk about quarters, we get more reliable numbers. But let's cover what we've got. Home building activity blew by expectations in January, with housing starts up 9.7%. According to the latest data from the U.S. Census Bureau and Department of Housing and Urban Development, single housing family starts increased 3.7%. Starts for units in buildings with 5 units or more came in at 431,000. Permits increased 7.4% from December, according to the data. Single family permits were down 1.7%, however, while permits for units in buildings with 5 or more units came up. Completions totaled 1.166 million in January, falling 1.9%. Single family completions increased 2.2% to 850,000, while completions for units in buildings with 5 units or more came in at 305,000. So I don't call that dramatic change. I don't call that. First, it's nowhere. The numbers we're talking about come nowhere near scratching the surface of demand, right? So I mean, we need to get that out there. Interesting quote from Lawrence Yun. For those of you who've been listening to the show for a long time, I have respectfully and sometimes not so respectfully disagreed with Lawrence Yun, the chief economist for the National Association of Realtors. He's quoted as saying, "Terrific news on housing starts in January with a solid 10% gain. This rise in single-family housing construction will help tame home price growth, and the increase in multifamily units should continue to help slow rent growth. The large gain in housing starts in the West, 10.7%, especially welcomed." Excuse me. As that region has been facing acute housing shortages. Ultimately, there's still large room for improvement given the fact overall housing inventory is currently near historic lows. According to Yun, the ascent could cause the Federal Reserve to hit pause on rates. It will announce its decision to hold or raise them in March. So I don't entirely disagree with that. At least it's stuff that kind of moves us in the right direction. We managed to see an increase of 2.2% in the single-family completions, but what's kind of concerning is that single-family permits are down. So by almost the same number, 1.7%. So I'm not entirely sold on what's going on. If you're looking to build something for the upcoming season, you're either already building or you're getting a permit to start, right? So one of our big things was this hope that all this talk from different builders, which we've talked about on previous shows, who've talked about how they want to start to build more affordable entry-level homes. We've heard the shtick, right? We've read the headlines. But if there's one lesson I've learned, you need to judge by actions rather than words. And we're just not seeing the actions that reflect that. It's a lot like the confidence numbers when we talk about what builders are doing. Builder confidence can go any direction that it wants to go. But my indication of builder confidence is, how many houses are you building? Right? If you tell me you're super confident, let's say your investment advisor comes to you and says, I am really bearish on Bitcoin. I think Bitcoin is amazing. And then in a moment of honesty, they let you know they're not investing in Bitcoin. Well, okay. Why would I judge what you're telling me as the truth when what you're doing completely contradicts what you're telling me, right? So that's kind of one thing I like to do here, because so often these headlines sell us on these ideas in terms of the way they talk about something, but then when you actually look at it, it's just not the same thing. All right. So generally, indicators to me that we're going to see a relatively flat season in terms of new construction. This may vary from region to region as there's different emphasis put. Maybe a small increase if we go on trends, right? If we assume that we can rely on some level of a trend happening. If you take a look at the chart that's included in the on the calculated risk blog article that's quoted in the show notes today. By the way, for those of you who are new to the show, typically what I do is in the show notes for a show, I'll include links to the articles that sort of fed the discussion that we have here on the show. So feel free to head over to therebelbroker.com to check those show notes out. I do try to include the show notes in every medium. So whether you're getting it through iTunes or you're getting it through Spreaker or you're getting it through iHeartRadio or however you're consuming it, those links should be there, but I just want you to be able to look at this for yourself. But there's one really good chart. The line you're going to specifically want to look at is the red line, and it comes from Calculated Risk, and it's the chart of single family built for sale plotting of what's being built for folks to go out and buy. And you can see where we peaked. I already discussed it a little bit previously. But anyone who looks at that should not be coming away thinking that there's high levels of confidence, that folks are out there really meeting demand. Because if you're out there looking, you know what the demand is. If you're a buyer who has found even a crummy house in some of these markets and made an offer at full asking price only to walk away and discover that it sold for $200,000 over asking price, you know what I'm talking about. You know that there are a ton of people out there, and that how much you're willing to offer over asking price is really just a reference point for how desperate you've become as a buyer, right? You don't come out of the chute on your first day look and find a house and think, I'm going to offer hundreds of thousands of dollars over this house. You think, I'm going to try and get it. You're going to talk to your real estate agent. How much below asking price can we come in? And your real estate agent may tell you, well, this thing will at least sell for asking price and most likely more. With any luck, your agent might say, well, what we can do is come in at full asking price, and if we get into a multi-offer situation, usually they'll come back and ask everyone, they'll ask the top offers to come back with their highest and best offers for a second round. So then we could ascertain, try to get more information at that point and then follow through there. That's one way a lot of folks go when they're first starting out. Now, I've taken folks on this journey. I've been the real estate agent in this mix where we have found a property. And what's worse is I had to do one of these last year. And it was in San Jose. So it was even more nuts than my hometown area of Morgan Hill. And it was one of those situations where it took 5 or 6 failed offers for these folks to finally, out of frustration and just wanting to get things settled, ending up making a way over asking price offer and finally winning the bid. That's not something I like to see. That is, and what's interesting to me about this is supply and demand are at their core the most real things, right, that we can gauge a market on. But what's bizarre is there's so clearly a demand here for this kind of a product that isn't being met. I'm actually very surprised we haven't seen someone step up and start building more. I know we had a little bit of a bulge in building back in like 2013. Things had kind of flattened out for a while in 2012. And then in 2013, we saw a boost that I thought would be maintained, that would feed a much bigger boost. And then 2014 followed on with actually less homes built. And then we saw a pretty big jump in 2015 that's now grown since then. But again, we didn't see the levels I thought. I figured once people saw what these things were selling for, and they were successfully selling for crazy amounts of money, I figured that would feed the beast. That would feed the builder beast, and they'd come out and go, hey, you know what? We can clearly build more of these things and get what we need to get in order to make the business worthwhile. And in a lot of the information we've talked about since then, we've talked about the additional costs involved. If you plot out what it costs to build a home, just as a difference between 2000 and say 2018 or 18 now, right? The costs associated with building a home have gone way up. And not because lumber's more or labor is more, but because the regulations and fees, the cost to comply with all that stuff is what has really pushed it. And I've talked about this before. When we saw the run up in real estate prices and just a huge, crazy buildup in the number of homes that were being built, the state looked out on that and thought, you know what, we're missing the boat. We're not making enough money off of these. So you actually had areas that were charging $100,000. If you were a developer and you were building more than 4 or 5 houses on a large lot, they were actually charging you a fee of $100,000 per house that was being built. And of course, that wasn't being paid by the builder. That was being paid by you. So if you go out to buy a home and the builder intended to sell it for $450,000, they were going to sell it for $550,000. And that's just one thing that happens in some areas. You had things at the state level in terms of additional regulations and compliance with different things. And this is the argument I make all the time to folks who tell me I'm nuts. Would you feel less safe buying a home that was built in 2000 than you would buying a home that was built in 2017? Is there any reason you can point to why you would feel less safe? Do you feel like the quality of the construction is lower? Do you feel like the materials are somehow lesser? So if we wanted one smart thing we could do to alleviate a whole lot of these problems, just rescind everything. Undo everything you've done since 2000 in terms of rules, regulations, and fees, and watch the homes get built to satisfy the need. Of course, that won't happen. The state is rarely going to ever find a position where they can get away with charging people money and then stop charging them that money at some point. And of course, when the market took a dump, the state didn't stop charging those fees. They didn't stop charging what is basically bribery for $100,000 per house. They still do it. None of that stuff is off the books. And they start trying to push all these other solutions where if they simply did that, the problem would really go away naturally because the barriers to motivating folks to build would be minimized to a point where they could at least be able to do it as well as they were doing it in the year 2000. Okay, so that's kind of where we stand on development. So the picture this paints for us as if you're a buyer who's trying to figure out, when's going to be the sweet spot for me to buy as a buyer. If you are a seller trying to figure out how much longer is this crazy market going to last for me to sell my home. If you're an investor trying to figure out, if I'm going to do a buy, fix, and flip, how much competition can I expect from new construction? The answer is not much. The answer from my buyers is it looks like more of the same for this season in terms of new home construction. For sellers, more of the same. It looks like you're going to continue to be in the driver's seat this season. The only change, and this is one where we still need to get some more data to push into our reality, is existing home sales. Now, anecdotally, I have seen an increase on the part of folks approaching me talking about listing and selling their home. That's good news. I think it's good to see that happen. We have a pent up bunch of folks who statistically would have sold their homes by now who have not. So it'll be interesting to see if that comes to fruition. I have a hard time believing that given the absolute low numbers on new construction that we're going to see existing homes coming onto the market at a level that'll really put a substantial dent in this, particularly in my marketplace. But other areas, right? Because remember, unfortunately, when I give you my ground truth, I'm in Crazy Town. I'm actually one stop out of Crazy Town. So still in Crazy County, but not quite in Crazy Town. So when I talk about my stats, I'm kind of an extreme example for here in Morgan Hill, for instance. But you may not be. Your community may be a little bit more borderline on some of this crazy, and you may find opportunities relating to this dynamic where we may potentially see more folks willing to sell the home they already own, but fewer companies building more homes. And these are dynamics that you as an investor or a buyer or even a seller would probably want to be aware of in your areas so you can make the smartest moves timed as well as you possibly can. Okay, we're going to go ahead and take a quick break, but when we come back, we're going to talk about some interesting numbers on one of the markets we cover. I guess at this point, we could probably call this one of the mega markets. I want to go over it real quick, sort of do a quick comparison to past years, past Januaries, and just see where we've seen significant changes. So don't go away. We're going to talk about that right after this.
Are you ready to jump in and start your search for your first investment property? Maybe you've decided that it's time to own your own home, or maybe you're ready to sell your home and move on to something new. No matter what your goal is, the Rebel Broker can help. That's right, aside from hosting this show, I am also the owner broker of Whitelaw & Sons Real Estate Services right here in Silicon Valley. With over 25 years experience serving Silicon Valley, Morgan Hill, San Martin, and Gilroy, I or one of my great agents can help you achieve your goals in real estate. So if you're ready to look into taking that next step towards achieving your real estate goals, point your browser at www.soldbyrobert.com. That's www.soldbyrobert.com and get in touch. Let me show you how I will earn your business and your respect. Again, that's www.soldbyrobert.com, or you can call me at 408-852-0525. California Bureau of Real Estate ID 00984-909.
Welcome back, everyone. Just spent a little quality time talking about home construction, the lay of the land, what we might see over the horizon. Trying to get a little bit of insight into what we can expect from the market over the course of the coming season. And one area I like to look at is Phoenix. And I think we can call Phoenix a mega market, right? We talk about Phoenix quite a bit, or we have in the past. There have been tons of communities, cities that have been mentioned in Arizona that are good investments, right? That really figured really prominently on some of our return on investment stats from various different providers. And we saw a lot of crossover when we were having this exact conversation a year ago and trying to figure out the smart places to check out. So many of them were Arizona cities. And what was interesting is once we plotted those on a map, we discovered these were part of the greater Phoenix area. These were areas that neighbored Phoenix to the north, to the south, the southwest, the southeast. So there's a lot of opportunity there. So whenever you're talking about Phoenix, it's also one of those cities I like to look at because I consider it an indicator city, right? And the ones we've always looked at have been, my area tends to be one, but from a bizarre, crazy standpoint, Phoenix, Las Vegas, New York, Miami are all, Dallas to a certain degree, have all been communities we've looked at because it's interesting to see, since they're also in different regions, it's a good way to kind of check and take the pulse on really high volume areas that tend to do a lot of business and kind of see what the trends are. Now, another reason is because Phoenix was dramatically hit by the downturn. So was Las Vegas. So was my area. So I think part of the logic there is, well, if they were hit really hard last time by a real estate downturn, the odds are they would be again. And since they might be more sensitive to that, they may be a leading indicator when things start to go horribly wrong. I know that in my area, it not only was the Bay Area one of those leading indicators, but submarkets, the bedroom communities, places like Gilroy, perfect example of a community to watch. If you're someone who does real estate here in the Silicon Valley area, look at places that tend to be bedroom community feeders at the outlying areas. Hollister might be the most sensitive. I've talked about Hollister before. I am not a fan of Hollister. I think Hollister is, and for some people over the last 4 or 5 years, this hasn't been true, but I think in general, over a longer period, Hollister is not a great investment unless you can get a great price. Now, there was a period of time where you could get a ridiculously good price on a place in Hollister. Rents have gone up, prices have gone up, and it still hurts my soul that I helped a person buy a Hollister home. Was it 2000? I think it was 2016, like February of 2016. And they've done well. I mean, it's appreciated since they've purchased it, but they ended up paying, I think, $615,000 for a home that literally, if they'd bought it a year and a half earlier, they would have paid something like $400,000. And when the market was further down, they would have paid $300,000 or $200,000. Hollister took a huge dump earlier than everywhere else when things started going bad before. And then Gilroy, and then, of course, Morgan Hill. And these can tend to happen pretty quickly. But those outlying communities could be really good barometers for you in your local markets. That's why I bring up Hollister. You need to find your Hollister, right? If you're in Memphis, what's a bedroom community for Memphis? I don't know anything about the area around Memphis, although I'm very interested in the Memphis market. As you know, we've had folks on the show that love Memphis. In fact, we're going to have an interview this Friday, and our guest this Friday has great things to say about Memphis as well. But in any event, whatever your city is, whether it's St. Louis or whether you're Dallas or you're Chicago, wherever, pick the area that has gotten benefits from being near a area that's seen renewed growth or a lot of recovery, that is like the least desirable place to live if you have to go to that place, and keep an eye on it. Doesn't mean you have to buy anything there, but keep an eye on it. Maybe have your realtor actually make you a search so you can see what's going on. If you start to suddenly see prices being dropped on a regular basis, if you start seeing the days on market starting to increase, I think this year is the year for buyers, investors, everyone who's interested in real estate to start paying attention to more of those indicators that point to a slowing market. There's a lot of things, there's a lot of balls in the air. And last time we could point to a lot of real estate specific stuff that was scary. We can do that again this year to a certain degree, but there's so much other stuff. We've talked about pensions. We've talked about the repatriation of dollars from overseas that's going to cause inflation. We've talked about all this monetization that's going to have to happen, and monetization means print money, right? Whenever they talk about monetizing something, that's what they're talking about. So keep these things in your mind. They're going to be excellent barometers for you to really see what's coming down the pike. All right, so let's hit it. There's some major points to take away from this, and this information comes from the Arizona Regional Multiple Listing Service. Number one, overall sales in January were up 2.8% year over year, including homes, condos, and manufactured homes. All right, so keep that in your head. 2.8% increase in overall sales. Now here's the next number. It's a number we're familiar with, and it's a number that's been reflected in some of these really crazy communities. Active inventory is now down 10.7% year over year. So there's 10.7% fewer homes in January of 2018 than there were in January of 2017. But we've seen an almost 3% increase in the number of sales that have actually happened. Well, how does that happen? Well, it happens, you end up selling off property that would have stayed on the market a lot longer. You end up selling off stale inventory. More inventory and less investor buying suggest that a price increase would slow in 2014. Price increases did slow in 2014, only increasing 2.4%, according to Case Shiller. In 2015, with falling inventory, prices increased a little faster. See, so all fed by inventory. Every single one of these is fed by inventory. Prices were up 6.3% in 2015, according to Case Shiller. With flat inventory in 2016, prices were up 4.8%. This is the 15th consecutive month with a year-over-year decrease in inventory. And when you look at the numbers on this, it's absolutely insane. And they've got all the Januaries. And again, this is the article from Calculated Risk blog. I'm going to have a link to this in the show notes. But it's just ridiculous. In fact, right now, we have the lowest active inventory in Phoenix since before January of 2008. The only reason I can only say that is because their data they're showing only goes back to 2008. If we go back beyond that, I'm sure. But the active inventory in January of 2008 was 56,874 homes. Today, it's 21,226 homes. The percent of cash buyers in January of 2008 was 19%. The percent of cash buyers today is 26.9%, but that's down. We peaked in January of 2011 at 49.9%. So half of all purchases were all cash in Phoenix. Then in 2012, it dropped to 49.5. 2013, it dropped to 44.1. 2014, it dropped to 36. Then it dropped to 32. Then it dropped to 27. Then it stayed in the 27 range, but still dropped. It went from 27.4 to 27.1, and now it's at 26.9. So that's another thing, a piece of data to look at. As you start to see the number of folks investing in a marketplace with all cash, typically you're defining that investor purchase as an all cash purchase, or at least a good segment of investors. Once you see that number dwindling, that is tending to show that you're seeing a squeeze in prices, meaning that really good deals are harder and harder to find, and that the prices you're paying for mainstream properties is probably going up, that there's a demand that isn't being met. Year over year changes in sales, they don't have the numbers for January 2008, but no, 2009, the year-over-year change in sales was 62.9%. So compared to 2008, why they don't have the numbers for 2008 when they have that number calculated is beyond me, but because they should have it. And then in 2010, the year-over-year change in sales was 22.2%. And that's just the number of sales. And then, of course, we start to see negative numbers in 2012, 2013, 2014, 2015. And then in 2016, the number goes back up, increasing 8.7%. Then in 2017 by 15.9% was the year-over-year change in sales. And then we had a 2.8% change in sales. So markets like that, and remember, we're trying to suss out what we can expect around the corner. What we're trying to figure out the next pivot in the market. We've talked about this for a while, pretty much since before the new year, where we're seeing signs that this could be a pivot year where we start to see things changing. And I think that change, and again, we've been talking about the change here now for a year. I believe that one of the first big things that would feed the change was going to be a drop in the stock market in October of 2017, which did not happen. And we saw some interesting stock things happen over the last month. As I talked to you today, the stock market's backed up to over 25,000. So there was a little bit of craziness in terms of fluctuation, but nothing really got kicked off as a result of that. It'll be interesting to continue on and see what happens. And I think maybe one thing I need to recognize, and all of us need to recognize, is that there are going to be an awful lot of forces that attempt to stall off any really bad things from happening. And that's going to range everything from simply saying everything's okay to throwing tons and tons of money at it. And maybe one of my shortcomings is expecting a rational response, a response that is geared more towards the idea of solving the problem rather than kicking the can down the road. And I think there could be an awful lot of can kicking. I think the experience we had with the last downturn, most of what happened after that was can kicking. There wasn't any real medicine taken. It was just delaying bad stuff. And now we're kind of in a position where things are less robust, less healthy, and we may face the same kind of challenges again from a slightly different corner of the market that wouldn't be where real estate isn't front and central as the key reason why things take a dump. So this is some interesting data. It's one more piece. In the past, we've talked about the same numbers in San Francisco and the Silicon Valley area. We talked a little bit about Miami, I think, a month ago. So more fuel for the fire, right? More fuel to at least say it is looking like things are going to either stabilize or perhaps even decline in some markets. Not really stabilize in some markets. I don't think what you can call what's going on in Phoenix in terms of this dynamic changing, what we just talked about relating to inventory. I think what we see is a continuing of this theme. When I talk about stabilizing, that implies potentially things declining. I'm not suggesting we're going to see declines. What I'm suggesting is likely we'll see a decrease in the increase. Does that make sense? So I don't see us seeing property values actually starting to go down in a lot of markets. There are some markets where I'm hopeful that'll happen because I think that would actually be helpful. But I think the reality is that instead of seeing maybe that 10% increase, we start to see a 7% or a 6% or a 5%, but a lesser increase than we've seen in the past. Now, that's what I've been hoping for a while, but given the latest manufacturing numbers, so much of this now hinges on current homes, existing homes being put on the market. I'm not real sure I can buy into that one. So sadly, when I say flattening, I guess what I'm saying is more of the same. I'm not anticipating increases that would go above and beyond what we've seen over the last year. So I guess that's, in one way, that's flat, but it really gives the wrong impression. It gives the impression that things are still good. And I don't think it is. When we see huge increases in values from year to year that's based exclusively on this bizarre low inventory situation, I don't think that's necessarily healthy. As always, the key is to pay attention to your local marketplace. Figure out what dynamics are going on in your market. My market's very interesting. We have seen rents not increase, but we have seen prices increase, and that's not sustainable. You can't keep doing that. So eventually, something's going to give, and rents can't. because now people have some options in terms of saying, well, I simply cannot pay that rent. So now I'm going to have to back off and go into an apartment instead of a single family residential. And once we hit that point, folks, landlords are just going to have to realize they can't charge that level of rent and have to realize they can't grow their rent. We'll see how long that goes. This is a similar problem to what we were seeing back when things went nuts last time, to the point where rents tended to keep pace, right? You would invest, you'd be able to make an improvement to the property and charge a rent that it was a new higher level. That's not really happening right now. We're seeing homes that should rent for a bit less, renting for a bit more, and we're seeing homes that should rent probably for a bit more because of how good they are, actually having to rent for a little bit less. So keep an eye on that in your market as well. It's an interesting dynamic. And just like we've talked about price banding in purchasing of homes, there's also price banding in rentals. Once you get over it depends on which end you come from. You can come at it from the 4-bedroom plus rental style home that tends to be a little bit more higher end, or you can come at it from the cost per month end. We start to see a lot of softening. We start to see homes staying on the market a lot longer and remaining unrented over about $4,200 to $4,500 in my marketplace. And that's resulted in a lot of homes that have 4 and 5 bedrooms charging only maybe $100 more a month per rent than some other homes that only have 3 bedrooms. So it's been an interesting dynamic to sort of watch that happen. And that's something that's that's a local fact for me. You need to figure out the same things for yourself to figure out what makes sense. Because ultimately, if you're going to do the buy, fix, rent, then later flip, you still need to be positive cash flow, and you need to make that work for you in your marketplace. All right. I hope that's been informative, folks. Thanks, y'all, for listening. I look forward to our chat with a guest on Friday, so make sure not to miss that show. Of course, I've already done the interview, but I thought it went really well, so I think it'll be worth your time. So make sure to carve out some time during your day on Friday to check out that show. I think it'll be very beneficial for you. All right, everyone. Thanks again for listening. I'll talk to y'all next time.